All right, welcome everyone. Thank you for joining us today for A&D Mortgage's co-partnered webinar with our friends from MGIC. Today's topic is funding of conventional and government loan. Let me go over a couple of webinar etiquette things first, then I'll introduce our speakers and turn the presentation over to them. So we ask everybody, please use the Q&A channel or Q&A part of the chat to answer your questions. We'll answer questions when we get past the formal parts of the information. You don't have to worry about poll questions. We don't do that today. And that's pretty much it. And if you can turn off your cell phone so you can pay attention to the people who are speaking. And those two lucky individuals are Mike Pearson. He's our Senior Vice President of Business Development here at A&D Mortgage, and Denise Rodriguez. She's the Southeast Account Manager for MGIC, one of the leading companies in mortgage insurance. And today they will walk you through everything related to the government and conventional loans and mortgage insurance. So with that, I will give the microphone to Mr. Pearson.
Good afternoon, everybody. Yeah, very excited to have this presentation today and especially be joined with Carl and my good friend Dennis Rodriguez with MGIC. So just a little bit about A&D Mortgage. A&D Mortgage is actually two companies. We have our origination engine, A&D Mortgage. We also have Imperial Fund, which helps purchase, secure, and do our securities for our closed loans. So you're part of a family of companies. We'll move on to the next slide, Carl. Okay, there we go. So you can see our footprint here. You can see we lend in just about every state in the United States. We're still working on North Dakota and Minnesota, but we're filling out the map quickly so you can see the states that we do business in. We do offer wholesale mortgage and correspondent lending, and we service all of our own business as well.
And I guess now is my turn. My name is Dennis Rodriguez, so think of Genesis, but with a D. Most people know me as Denise, but I have been with MGIC a little bit over 3 years, in the mortgage industry over 30 years. MGIC we're the pioneers of the private mortgage insurance industry. It all started with us back in 1957. So we just celebrated our 65th year. And we're here to help you understand a little bit better why MGIC or why private mortgage insurance is your friend, your customer's friend, and your realtor's friend. So that's what I'm here to help you guys understand better and any questions that we can answer for you.
All right, so just to get it started and just to get the wheels turning a little bit, hopefully this is information you know a lot about, but we want to dig into some of the nuts and bolts of FHA and conventional lending, as well as some of the specifics of the reasons you would choose A&D. And then we want to go into some mortgage insurance guidelines also, which is very exciting. But our first slide here, we kind of go over the loan limits. So generally, in most areas, FHA for a single family home is going to cap you out at about $472,000 as far as loan amount. And then, of course, there's high cost areas and multi-units where you can get different loan amounts there. On the conventional side, we're talking about generally about $726,000 with high balances going over $1 million. And then again, depending on the number of units in the property, if you have a fourplex, for example, technically you can go all the way up to over $2 million in loan amount on conventional loans. Next slide. Looks like we're having some technical difficulties. So then I will just talk. So let's talk about why A&D Mortgage. So when it comes to conventional lending, the nice thing about A&D Mortgage is we have a good background in both conventional FHA financing and non-QM products. The nice thing about our company is we're all service driven. Our sales staff and our underwriters know how to pick up the phone, know how to diagnose and go through scenarios and file issues with you. So you'll find that we offer all the programs across the spectrum. Specific to conventional loans, we offer all your standard conventional loan programs, your conforming, your high balance loans, your home ready, home possible loans, refi now programs. All of those options are available for you here at A&D Mortgage. What really sets us apart from most of the lenders out there is our attitude towards service and customer service. Our underwriters are directed to reach out and communicate with you on your loan file issues, go over conditions, talk you through our process. Our account executives are not, I hate the term order takers. We're not order takers. We're very used to, especially with our background in non-QM, are very used to analyzing credit, reviewing documents, helping you find the best solution for your borrower. You won't hear just run it through AUS and let that make the decision for you. We'll definitely go through and help you find the right scenario for you. Another great reason to use us, particularly on the conventional side, is we follow the agency guidelines. So we follow directly what Fannie and Freddie say. We don't have overlays. So if they require a certain calculation for 1 year self-employed income borrower, we're going to follow that same calculation. We're not going to add additional things on. We're not going to add additional documentation. So we're going to follow exactly what the agencies are telling us to do. Just kind of going a little bit into the programs, just a high level overview. Again, we kind of talked about loan amounts on the conventional side. For most programs, single family homes in most communities is going to be $726,000 and some change. We do all the fixed rate mortgage programs. Home Ready is a down payment, or excuse me, like a first time home buyer program, Home Ready and Home Possible, that allow higher financing up to 97% financing, still with the low 620 credit score. They are generally for low to moderate income borrowers and generally, again, for first time home buyers. We do, again, also offer the high balance loans that start off as high as $1 million, and depending on the number of units can go up to $2 million. So there's a lot of flexibility in that high balance bucket. We also offer, we don't see a lot of these programs, but I always like to bring it up because it's a program that sometimes isn't talked about too much. There's a refi possible and refi now that are offered by both agencies. These are high LTV rate and term refinance programs that offer great terms, lower interest rates for low to moderate income borrowers. We're talking about borrowers with income below 80% of the area median income. So for those borrowers, there's a lot of flexibility brought into those programs. Higher DTIs, I think, allows up to 65 DTI. It does give an incentive, a lower interest rate for borrowers to get into those loan programs. It also has some flexibility as far as how much closing costs can be rolled in, and there are some lower documentation requirements on there. So it's a great program. Dennis, as we're going to roll into, let's just kind of transition into some of the MI programs.
Absolutely. So MI, private mortgage insurance. What is private mortgage insurance? Private mortgage insurance is a protection pretty much for you, for the lender, for the broker, in order to protect you from a possible default from your customer. Now, the way that this works is whatever the percentage that the customer is putting down, that says 3% in the case of conventional, because you do know that for conventional financing, you're allowed to put down as little as 3% compared to FHA 3.5%. So whether it's 3%, 5%, 10%, or whatever that might be, anything over 80% loan to value, there's different coverages that you will be allowed to insure that property. Now, obviously, you're going to be running those files through your desktop originator or your loan prospector, whether it's Fannie or Freddie. The same as A&D, we follow Fannie guidelines. So when you run it through DU, obviously, A&D is going to go ahead and review those findings and come back with the conditions for you. And then we're going to go ahead and insure that property or that loan for you guys. As far as the different options, there's not just your traditional monthly mortgage insurance. We have the financed MI, just like FHA has a financed option, conventional has it as well. So whatever that proportion is, or that amount is that is chosen to be the MI according to the risk based of that transaction, you can actually add that to the loan. And as long as it's not over 90%, because you don't want to get into the the TRID requirements, but as long as it's up to 90, and depending, obviously, again, is based on risk, just like Fannie has risk-based rates. Same thing happens with the mortgage insurance industry. So with that being said, you can do financed MI, you can do monthly MI, you can do split MI, you can do upfront MI. So again, not just your traditional monthly MI, which is what most of us are familiar with. The options with that as well is, as far as MI cancellation. MI cancellation, it's something that the conventional side allows you to do. FHA, we all know that it's for the life of the loan. For the conventional side, once you get to a certain percentage of coverage, then that MI has to be automatically removed. It is by law. It is the federal regulation. You have the Homeowners Protection Act that it is automatically removed once it hits the 78% coverage. Now, with that being said, you don't necessarily have to wait the average of about 61 months. That it's what it usually takes for that MI to hit that level in order to be removed. After 2 years, you can actually request to your servicer that you want to remove that mortgage insurance. And there are certain requirements for that as well. Obviously, your lender is gonna decide if they have any overlays. And at that point, I'm sure the one that most people are familiar with is that you have to have had a perfect payment history. Then, of course, the appraised value is another one that I'm sure the lender is going to request. But again, you don't have to wait those 61 months, 7 years, 10 years, whatever it might be to get to that amount. You can actually request that after the first 2 years. So that is an option that is available to your customers as well, but they do have to decide with the servicer. MGIC, as your MI partner for A&D, we do not control that. So it's not like you can call us and say, hey, I want my MI removed. It's not up to us. That it's something that it has to do directly with your servicer. So I'm not sure if there are any questions so far, Mike.
I got a question about lender paid MI. Teresa, can you elaborate? Are you just asking if it's offered, or can you put in another comment in there? Yeah. Yep. So we do offer lender paid MI.
So I'll talk a little bit. Yes, I'll talk a little bit of lender paid MI. Lender paid MI absolutely is available. However, we haven't seen lender paid MI be an option in the last few years because lender paid MI, it gets to be a little bit expensive. So unless you have this high credit borrower with a really low DTI and several of the risk factors that are helping the borrower with a better option, then that's when you would choose the lender paid. Of course, there's other things that you can use, some of the seller credits and stuff that you can use to pay the MI as well. You're not just limited to the borrower funds. So that is something that is available. But again, I suggest if you want to know what your MI will be before you run through all the trouble of running an application and all that, you can always access our website, mgic.com, and there is an MI calculator news. Please contact your wholesale team at A&D in order for them to give you the access to that option, but you are able to calculate and compare the difference between a lender pay, borrower pay, or whether it's financed into the transaction.
Perfect. Yeah, I just want to let you guys know if we seem a little shocked and clunky in this presentation.
I can't hear you, Mike.
Oh, you can't hear me at all? Can you hear me? How about now? Am I there?
You're there now.
Can you hear me okay now?
Can you hear me?
Okay? Well, I hear an echo, but I just wanted to let everybody know we had some technical issues. You might notice Carl is not on the presentation. His internet crashed in Jacksonville, Florida. So you can't hear me.
Yes, I can hear you.
Okay, so we apologize for the technical difficulties. We'll run through this presentation as best we can. We may have to reschedule and pick it up again, but we wanted to.
Sorry, guys, I'm back.
There we go. We got Carl.
Oh, he's coming back. Yay, Carl.
Yeah,
we faked it until you were able to get back on. So
okay, thank you, guys.
Sorry. We did.
My home has sometimes spotty service, and today I decided to do it today. So
Okay, if
let
we
me
can, let's just transition into the government's program page and transition to a little FHA, and then I want to give Dennis the chance to go through the kind of MI versus FHA comparison. So if we can go into that, the government program slide, Carl.
All right. Let's try this again. Sorry, it looked like it was about to do it again. Okay, share my screen. All right. So where are we going to go to?
Yeah, we're going to skip ahead to the government programs slide.
Okay. Yeah. So did we cover
so we talked a
mortgage
little bit
interest?
about MI already. We went through some of our conventional loan programs. So I just wanted to cover a little bit about what we do on the FHA side. Unlike the conventional, we do have some specific requirements to A&D. For example, you'll see on here 620 score. You'll see DTI up to 40 to 55. So there are a few overlays that we do have on the government program. So we do offer all the programs. We do offer FHA streamlines, which we haven't seen in a little bit, and we also do the high balance loans on the FHA side. But primarily, you're looking at 620 and greater scores. You're looking for those 55 or under DTIs, and the rest of it is standard FHA. So, so let's go into, Dennis, do you want to go through the slides on comparing private MI and FHA?
Sure. Yes. So we're going to do a couple of comparisons so you guys can see, the difference between conventional and FHA. So for this exercise, we have a couple, Rick and Jill, two borrowers buying a home at $300,000. Now that you can find those in Florida, many of those, but for this scenario, we're using a $300,000 purchase price and a 95% loan to value. So the difference, here we go. So we have a 760 score. So as you can see in the example, we're dealing with a 760 credit score, two borrowers with a DTI of 35, a 30-year program, and a 95% loan to value. So as you can see in the first column, which is the blue column, you have the same down payment. They're both FHA and conventional are given a 5% down payment. So it's a $15,000 down payment. Your base loan amount is the same, $285 for both. Then you have an upfront premium for FHA. In this particular case, is $4,988. I know that yesterday there was the announcement that that premium is going to drop 30 basis points, and that starts, I believe, sometime in March, correct, Mike?
March 20th, correct. March 20th. New case number is March 20th.
Okay, but right now, that's, it's still at the 85. So we're at upfront MIP of $4,988. And for us, for MGIC, the PMI is 0. There's no upfront. The total amount borrowed is $285. So it stays the same for the conventional side. And of course, for the FHA, you have to add the upfront premium, which then totals $289,988. Interest rate, yes, we're accustomed to seeing that FHA rates are a little bit lower, especially nowadays. For this exercise, we're doing a 6% interest rate for conventional, 5 3/4 for FHA. The monthly MI in this particular scenario, it's only $50 a month. Yes, take into consideration that there is a 760 FICO. Again, MI, just like for Fannie and Freddie, and interest rates is based on risk. So if you have we'll see the next scenario with a different credit score, so you can see the difference in as far as the monthly MI payment. So again, you have a payment of $50 a month compared to an FHA monthly MI of $189 a month, for a total monthly payment of principal, interest, and mortgage insurance on the conventional side of $1,759 compared to $1,881 on FHA, which is a difference of about $130 approximately, $120. So that alone is a big difference on top of the upfront premium. Then we're going to assume a 3% annual appreciation. Of course, the last 2-3 years have been a lot higher than that, but the norm is about 3% annually. So the estimated MI cancellation usually happens within the first 5 to 7 years. So in this case, we're going to do 61 months. FHA, as you know, is not cancelable, so you have to keep it for the term of the loan unless it's a 90% or lower. But for all intended purposes, FHA is usually to go with a higher loan to value and the lower credit score borrowers. But in this case, we're doing, again, in 95, the estimated MI cancellation happens at month 61. So then your total mortgage payments, what is principal and insurance, principal and interest, will go down to your original $1,709. So that at that point, we're removing the $50 a month MI. In the case of FHA, since it doesn't get canceled, your MI, it's included still in your mortgage payment, and it's $1,867. The reason that is still a little bit lower than the original 1881 is because FHA calculates the MI premium on the annual, the loan amount at the end of every year. So it's based on the loan amount of the actual balance of the loan. But still, you see the difference between the monthly MI for MGIC. At that point, it has dropped, so it no longer exists or is added to the loan. And for FHA, it continues on. Let's see the next scenario. In this case, we have a lower credit score, 680 FICO, still same borrowers. Now we have a housing DTI of 45%. Obviously, the risk in this case is higher. You have someone with a lower FICO, someone with a higher DTI. So everything above is the same as far as your down payment is $15,285 loan amount. All that stays the same. Now, when we get to the monthly MI, you now see a monthly MI payment of $126 a month compared to the other one that was $50. Your FHA stays the same at $189, still a lower MI as far as the conventional side. Your total payment is $1,835 compared to $1,881. Again, your MI drops at the 61st month, and your total payment then drops to the $1,709. And again, FHA stays at the $1,867. So considering not only the fact that you can drop the MI on the conventional side, you also have the loan limits are a lot higher for the conventional side, but keep in mind that you can still do a 3% down payment for conventional when an FHA is 3.5%. So, you know, the comparison is pretty close, except when it comes to the actual mortgage insurance, that for the conventional side, you have better options in this particular scenario. Any questions, Mike?
Nope, they can hear me now, so that's good. We covered a little bit verbally the MI cancellation, but do you want to maybe zip through some of these slides so they can see it in writing? And just so you know, we will send you out this presentation, everyone on the call, so you will have a chance to look at this. And obviously, you know, because of just circumstance this morning, we don't mind going through this, one-on-one with anybody individually who wants to do this as well.
Absolutely. So again, conventional mortgage insurance may be canceled. You have the MI cancellation. There's two options. You have either the original value of the property, and when I say the original value, means whatever you used for financing, whether it was a purchase price or the appraised value, that's what the original value of the property is. So that is your traditional insurance. So the cancellation is based, as I mentioned, in the Homeowners Protection Act. So you have to get to that requirement of that 78% coverage before that MI gets canceled, which is, again, usually about 60 months or so, about five years or so approximately. The MI cancellation based on current value. So you bought the property 2 years ago, and now, of course, is worth a lot more 2 years later. The Homeowners Protection Act steps aside. No longer gets involved with that. Now it's going to be based on Fannie and Freddie and your seller servicer of the transaction. So if you want to use the current value of your home in order to remove the MI, then now it's based on Fannie and Freddie, which usually requires that you have to have the loan a minimum of 2 years. Mm-hmm. And then, of course, the servicer at that point will decide on some of those overlays that they may have. Now, the original value, again, as I mentioned, is based, the automatic termination is based on the 78% loan to value. They have the initial amortization schedule, which is, you get provided, or your customer gets provided with that at the closing of the transaction, and the date the loan balance actually reaches the 80%. So although you see 78% termination, that is the lender required cancellation. Now, the borrower can request the cancellation, and it is based at that point on 80%, not 78. So your customer can actually request the MI to be canceled on the original value. Again, that usually takes between 60 months to 72 months, all depending on what the original value was and what the down payment of that original transaction was.
And I think you just answered this question, but I wanted to ask you that. I had a question on this. So it's 78%, and it says based solely on the initial amortization. So even if they prepay on it, it's still going to follow from the original time frame, or if they reach 78 because of prepayments?
Yeah, actually, that is an excellent question. And yes, absolutely, you can actually prepay. You can actually send money, additional money towards the loan. And that will get applied at that point because the loan balance will get reduced. So absolutely, you can actually pay down the transaction, yes.
Excellent, nice.
There is no limit on that. There's no penalties, and there is no limit on that. So if the customer pays down the loan, absolutely the MI will be canceled.
Okay.
Now, as I mentioned, also the current value. So your house now, 2 years later, all of a sudden increased $50,000, $60,000, $100,000. Fannie and Freddie typically require that you have to have the loan seasoned for a minimum of 2 years, and the borrowers have an acceptable payment history. And of course, then at this point, they require that the loan to value be based on a current appraisal at 75% or less of the value of the property. So now no longer the 80% comes into play. Now it's 75 from the second year to the 5th year. So if your loan is less than 5 years old, Fannie and Freddie say we want to see a 75% loan to value in equity transaction in order for them to allow the MI to be removed. And now again, that also has to do with your investor. If it is more than 5 years, then the 80% loan to value will be used, and that will be on the current value as well. So now, as far as MI solutions, well, before we move on to that, any questions as far as MI cancellations, Mike?
I don't see anything in the comments. You can add comments into, on the side there, and we can answer any questions you guys have. So feel free to type in any responses.
Okay, so MI solutions. This has to do with how MGIC can help you with your borrowers and how to do more than just tell them, oh, you're only putting 5% down. You're gonna have to add this extra insurance, and this also will help your realtor partners as well. In this case, the MI is more than, like I said, it's right there, just a product, or insurance can help your borrowers qualify for a higher loan amount, as well as you be able to get a higher loan amount for your borrower, which obviously what does it do? Puts more money in your pocket. The same goes for your realtor. They can actually help that customer look for a higher purchase price as well. Now, one thing that I want to keep in mind for most of you, because I'm sure that a lot of you don't know this, but when A&D goes and calculates your mortgage insurance premium, your MI premium for conventional financing, we, MGIC, does not take that monthly MI payment into the DTI calculation. Now, I don't want to confuse you guys. You still have to have that full DTI in order for Fannie and Freddie to run the DU. So the MI calculation is part of that DTI. However, when you're running the MI premium in order to run that quote for MI, we do not take the MI into calculation. So for example, you have a 45 DTI, including everything, PITI and mortgage insurance. In our case, we just do the PITI, meaning mortgage, interest, taxes, and insurance, but your homeowner's insurance, not your private mortgage insurance. So then all of a sudden you go from a 45 DTI maybe to a 42. And yes, there are different tiers that are taken into consideration as far as risk. So that actually helps you and your customer in qualifying.
It's interesting. I haven't heard that before. Yeah, because that can affect,
Yes,
depending on your DTI, it can affect whether or not you can get MI or the pricing of that MI, correct?
absolutely.
Cool.
So again, What is MI for? MI4 is for your first-time home buyer. Most first-time home buyers are unaware that you can put 3% down. Most people still think that they're required to have 20% down payment. Even at an 85%, so many options on an 85% loan to value. You're putting 15% down. So, you still have to have a little bit of money left. You don't want to use every single dime that you have saved all these years to buy a home. You never know. There's going to be emergencies. You buy a home for, even if it's a brand new construction, there's always something you want to do to the house. There's always furniture. There's always all kinds of stuff that you want to do after you close. Make sure you don't do it prior to closing. So, the first time home buyer, the dreamer, that person that they're exactly that. They're dreamers. They're people that have gone to school and are creating a life here in the U.S. And I want to make sure that they're able to attain the American dream, which is to own a home. Then you have the move-up buyers. You have the buyers that bought the little one-bedroom condo or single family, two-bedroom, and all of a sudden they have a family. They're growing, so they're considered move-up buyers. So they're buying a bigger home. And then, of course, the bidding warriors. We all know at least one, as to, okay, a house is up for sale for $300,000. All of a sudden, somebody comes in and said, I'll offer $310,000, and it goes up from there. So that applies just as well. And MGIC is here to help with those as well. Any questions?
We got you muted, Carl. Yeah, we did have one thing came in that asked, it says 3% for PMI, correct? And that is correct, yes. Conventional requires at least 3% down, and they follow up with the FHA down payment, which is 3.5%. That is correct.
Yes.
All right. Let me check the other area. Yeah, there's no other question.
You guys, by the way, you have any questions? Anything that anybody needs to know about MI, you can access our website. And I'm sure Carl is going to go through that in a little bit, but you can always access our website at mgic.com. There's all kinds of resources and tools that it's open to all of you. You don't have to be approved with a master policy in order to be able to access those tools and resources. Just go to mgic.com. We offer amazing trainings, anything that has to do with self-employed income calculations and all that good stuff. So go to mgic.com/trainings and you'll find everything there. Again, play around in our website and you'll be able to see all the different options.
Great, thanks. All right, and I'll take it from here, guys. So sorry again for the hiccup with my internet service. I'm used to it, unfortunately. Okay, so A&D Mortgage, as we often say, we're your partner for growth, and we do that really with four major pillars that we emphasize, which is, of course, a streamlined loan process, the fact that our team has a very can-do attitude and a lot of expertise, as Mike's shown you, on various loan products, whether it's government, conventional, or non-QM. We do offer loan solutions that grow. So particularly in the non-QM space, we underwrite our own we do our own underwriting guidelines, so we can adapt them to market conditions and add new products, take away new products, change LTVs, FICOs. So we've got a lot of flexibility that a lot of other lenders don't currently have. And we're always monitoring to make sure we can add something new to the mix. So just to cover that very quickly, we do have a couple of tech tools for our brokers if they're already approved with us. One is our quick pricer, where you can price out conventional and government loans and the non-QM stuff. It's all very easy to use, and Mike could do a one-on-one with you if you've got questions. We have Appraisal Center, which is part of our broker portal, or LOS. We have probably over 20 approved AMCs, so you can find pretty much any AMC that you want and order as many appraisals as you want. But it's all housed in the same centralized platform, so you don't have to have individual credentials for every AMC, and you check and manage everything separately through their websites. We try to maintain everything single and centralized within our platforms. And the other platform is AD Studio, which is our online marketing portal. It functions similar to Canva with a little bit more flexibility. We've got templates for email, social media, product flyers, PowerPoint presentations. It's very customizable. You just upload all your information into your account. It pretty much pre-populates 80 to 90% of it, and you just have to do a couple of little minor things and switch things around. We do regular webinars like this. So if you are a new broker working with us or even an existing one, we do a broker orientation, usually the middle of each month. So next month it'll be the 14th. We kind of recover all of our product ranges, our loan process, all of the marketing tools that are available for you. So if you're new to us, it's a great tool to get you started with a running start. And if it's a good refresher if you're already an existing partner. And then we're going to do another expertise webinar like this one with a gentleman named Rick Sharga. And we'll look at a lot of housing data and give you guys insights on where we foresee the spring housing market going. I'm surprised that this question did not come up, but yes, we do record these webinars. We post them on our Learning Center. For those who register, we will email you a link to it, as well as a copy of the presentation. Hopefully we can edit out the sound of animals in the background. And then this is a link to all of our social media related to A&D Mortgage. So we have presences on Facebook, LinkedIn, YouTube, Telegram. We've also recently added TikTok. I'll send that link over to you guys as well as part of the updated presentation. And then as Dennis has indicated, we've got all of theirs as well for MGIC. I think the training one is not here, but we can send that along. But there's all their Twitter handles, LinkedIn, YouTube, Facebook. And if you need to reach Dennis directly, you can scan a QR code with your phone. And does that go right to your email, Dennis, or is that? Yeah.
Yes.
All right. And then I'll send you guys out also an email right after this is over with both Mike and Dennis's contact information if you need to get in touch with them. We did get another question. Let me see really quick. 3% needed for first-time home buyers. Is that correct?
Yes, that 3% is required to be a first-time home buyer, correct.
And that's really only through Home Ready and Home Possible, if I remember correct?
Correct.
I hope that helps that gentleman.
Now remember that for what, first-time home buyers, if it's been 3 years, you're still, 36 months, you're still considered a first-time home buyer.
Correct.
So not necessarily
no
a first-time home buyer, right.
Yeah, not your first home, but back in the market. So, all right. Well, with that, let me just check one other place, see if we got any other additional questions. Nope, we're all good. So I think we're clear on questions. So with that, we can kind of close out. Mike, Dennis, thank you very much for putting together the presentation, despite our little hiccup. Hopefully everyone had a good time, and we will be back next week, in a couple weeks with the new broker orientation, and then back in a month with the expert panel with Rick Sharga. Dennis, is there anything you want to close with on behalf of MGIC?
Absolutely. Again, thank you all for being here, and sorry for the little hiccups. Any questions, anything that I can help you with, my information is on there. And again, just go to mgic.com/trainings, and you'll be able to sign up for any of our upcoming webinars. And some of them are live and some of them are recorded. So just pay close attention to that.
We got one last sneak question in. Can we do 3% on a duplex?
I can Google that while we talk. I believe it's 5% down for duplex.
I believe so too, and yeah. I mean, obviously it's owner occupied.
Right. Yeah. What we can do is I can email you that question back out, Jose.
Yeah.
Yeah. I don't want to be wrong, so I can send out the question or send out the answer.
Right, and I can't recall off the top of my head if it's 3% or 5%, but I think Mike is right. I think it's 5%.
Yeah. I'll download Jose's email address for you and get to, Mike. So, all right. Well, thank you, everybody. Have a great rest of your day. Have a good rest of the month. Hopefully, it'll pick up for everybody. And do more conventional loans.
There you go.
Yeah,
Thank you all. Thank you
absolutely.
for
And
your time
remember,
today.
second homes. We can do second homes as well. Second homes, 10% down. So 90% loan to value on second homes. We can insure those as well.
All right. Thanks, everybody.
Excellent.
Bye.
Bye.